Welcome to part 3 of my Technical Analysis Foundation course, In-Depth Support and Resistance tutorial. This lesson is brought to you guys by Femex. I'll talk more about them later in this video. Let's go over the content for this lesson. The law of supply and demand. It's going to be a little bit of Economics 101. We're not going to get into too much detail, but a basic understanding is essential. 2. What is a support and resistance level? Well, that's the whole point of this tutorial. I'm going to explain to you guys what it is with the help of some examples. Then we're going to go into the psychology. We're going to talk about the specific market participants and what their roles are. Finally, we'll finish off with data analysis and support and resistance flips. Data analysis is going to give you guys a nice structured framework, similar to what we had for candlestick analysis, but applied to support and resistance with some small differences. And flips are just a key thing you need to understand about support and resistance levels. So I'm going to go over the usual disclaimers. This video is for entertainment purposes only. Any information spoken or written should not be interpreted as financial advice. Carry out your own independent verification of facts and data. Don't just take my word for anything. I am not a financial advisor. I do not hold any relevant qualifications. If you seek financial advice, speak to a professional. And finally, trading is an extremely risky activity. Your trades are your responsibility, so trade at your own risk. The law of supply and demand. Let's start with the law of supply. It's pretty simple. At higher prices, the number of sellers will increase. Well, if the price of something goes up, there's more money to be made on it, and it's more attractive for someone to sell. The law of demand. At lower prices, the number of buyers will increase. When something gets cheaper, more people want to buy it. And that is the basic concept. Let's look at this chart over here. We have on the y-axis price, on the x-axis quantity. Price is the price at which a good is being sold. Quantity is the amount of this good being sold. This is the demand curve. This is the supply curve. This represents the buyers and this represents the sellers. So for the purpose of this video, I'm actually going to call this buyers and this sellers. So in this example, we have the price set at $15. So at $15, we can see that buyers have lost a lot of interest. Why? Well, let's look at the demand curve. What represents the buyers in this example? Buyers only want to buy 10 units of this good at the price of $15. At $15, we draw a line, and the first curve that's hit is the demand curve, representing the buyers. So we draw a line down, and we can see only 10 units will be bought at this price. But because the price is high, there are a lot of sellers. A lot of people are trying to sell this good at this price. So there's 50 quantity of total sellers, but only 10 of those are going to be able to sell. So we have 40 units of surplus supply. Now the sellers aren't just going to sit on these 40 units. So what do? They lower the price in an attempt to sell, but they don't know at what point buyers will be satisfied. So what happens? Now the price is at $5. Well, at $5, we have 50 units ready to be bought by the buyers, as you can see over here. So this line goes up and the buyers are willing to buy 50 units. But sellers aren't making a lot of money at $5. So only 10 units are available for sale. So now the opposite happens. We have a shortage of supply. So what do buyers do? Well, the buyers say, I'm willing to pay more than $5. So the price moves up and the price bounces in between these shortages or surpluses of supply until it finds equilibrium points, which it will temporarily keep. But these curves aren't static. They're constantly moving. Therefore, the equilibrium point, which is right over here at $10 in this example, there's an equal amount of buyers and sellers, so price doesn't move. But remember, buyers, they're not always going to be willing to pay the same amount for the same thing. Their demand is going to either increase, in which the equilibrium point will increase, or the demand will decrease, in which the equilibrium point will decrease. Same with sellers. They can move as well and change this equilibrium point. Price is on this constant journey trying to find the right place to be. So we're going to apply that theory to support and resistance. Let's take a look at a support level. A support level is a horizontal level or area where buyers are expected to step in. We look at a level like this and we think, where you can look and see these green arrows show price hits this level and it moves up. Price comes to this level, it moves up. Price comes to around this level, it moves up. Same thing here, same thing here. So price keeps moving up at this level. What does this mean? It means, well, the price is quite low, so buyers are plentiful, but sellers, there aren't that many people who want to sell at this level. So every time the price reaches this level, it has to move up. Now let's look at the opposite. Here we can look at $11,500. That every time the price reaches this level, it drops down. Reaches this level, it drops down. What does this indicate? Surplus of sellers. Lots of people are looking to sell at this level. So when we identify a resistance or support level, we're trying to find levels where we think buyers or sellers are going to step in and push the price in the opposite direction. Now that we have a basic understanding of demand and supply, we understand what a support and resistance level is, let's look into the psychology of support and resistance. I'm trying to paint a complete picture, so bits and pieces is what you have right now. By the end of this video, I hope you have a really good in-depth understanding of what's going on. And hopefully all the pieces of the puzzle, they come together by the end. Market participants. So if we're looking at psychology, well, psychology is what people are thinking. So let's look at which people are involved in the market. First, we have the longs. Longs are people who have already bought and they benefit from the price moving up. Shorts. Shorts are people who are on the sell side. They have made a bet on the price moving down. So when the price moves down, they make money. Flat. People who are neither long or short. These guys hold no position. They are either uninterested or they're looking to enter and waiting for the right moment. These are the three participants. Longs and shorts, you can think of them as the bull army, the longs, and the shorts being the bear army from our candlestick example before. Looking at this chart, I want you guys to tell me what you think the longs, the shorts, and the flats are doing. So people who are flat, people who are short, people who are long, what are they thinking? What is going through their mind as price is coming down here? I think the longs are scared and hesitant. They've been losing money for a long time now, but they see this tiny little candle going up, so there's going to be a slither of hope that the price is about to move up. Shorts are going to have the exact opposite opinion. They are very comfortable. They'll be getting overconfident right now. Price is moving down for a while. The bear army, if you look at the candles, remember last week's lesson, the bear army is winning. But there is a slight bit of doubt for them because price has moved up here. It's nothing serious, but maybe they're thinking, I had a lot more money when price was at 8,600 than I did up here at 8,720, around about where it is. People who are flat, well, they see the price go up, and they think they should have bought here. They would have made money. It's only happened once, so they don't think too strongly, but that's what's going through their head. Now, let's analyze what's happened here using demand and supply, because I really want you guys to have this ingrained in your head. The more you understand what is going on in the market, the more likely you are to develop better intuition, better ability to come up with your own original strategies, and originality is extremely important. When you're able to look places other people aren't looking, that's when you're going to find edges that are going to make you money. Shortage of sellers. That's what happened here. Price moved well below the equilibrium and it corrected. So it went back up in an attempt to find the equilibrium point. There were lots of people who wanted to buy at 8,600 because they thought it was cheap. So when no one else was willing to sell at this price, they moved the price up. The buyers said, well, I'll buy at a higher price. And here we go. Price reaches this level. All three market participants, if you look at this, now look at this 8,600 level, and they think, next time the price comes here, maybe I should buy. Now let's look at a much more significant level. Price reached 8,830. And what happened? 1, 2, 3, 4 candles all showed rejections from this level. Clearly, there are not that many buyers up here, so not enough people really want to buy at this price. but the sellers are all competing, and eventually there were no more sellers. So what happened? Well, the sellers decided to lower their prices until they could find some buyers. Let's analyze the psychology of what's happened here. The longs, they're scared because the price has been here for a while. Their position is open, and now, because they didn't sell there, after 3 candles, they have a lot more regret than the people who didn't buy here because they had a lot more time. A lot more people had time to get involved. But they're going to be eager to get out of their position should price come back to this level. They're going to think, oh, now finally I can get out where I messed up before. Shorts, they are euphoric. Price was here for a while. They were probably scared. Is it going to go up? Is it going to go down? And it went down. Their only thought is maybe I should have sold more there. Maybe I should have opened a stronger position. So next time price comes back up there, they're going to see it as a second opportunity to double down on their positions. The people who are flat thought, well, maybe I should have sold there. As you can see, it's the exact opposite of here, but this time we have 1, 2, 3, 4 candles supporting the argument. Now, I'm going to get more into the data analysis later, but I'm sure a lot of you will have noticed that. So should the price return here? Everyone wants to sell, more so than they did at 8,600. What happened afterwards? Guys, price went here, price bounced up, price came back down to a similar level, and the close is over there. We were looking at the 8,600 level specifically. The candle went through, but it did bounce up. Here, we had a much cleaner hit where the price resisted and came down. So let's look at the difference between these two. In this case, we looked at 8,600 as a rough level, but the price broke down quite far below that, almost hit 8,500. Whereas in this example, the price held really strongly. It barely went above this wick over here and rejected. So what's the difference between these two? Well, to put it simply, this is a much stronger argument for a resistance level than this is for a support level. Unsurprisingly, this held better. I'm also going to add that we're going to discuss trends in the next lesson. And as we can see, the bear army is clearly winning this battle. So is it surprising that their forces held a better defense than the bull army? That's for next lesson. But for this lesson, let's talk about how we can assess the strength of our support and resistance arguments, which leads us into data analysis, support, and resistance. Before I get into the data analysis part, remember, all these courses are made free for you guys. They take an immense amount of time and energy, and I want to make more for you. But without a sponsor, it just really isn't worth the time. I'm happy to bring out free content, but to make it of this level and quality, I need your support. If you can click on my Femex link, which will be in the description and comments below, it'll help me make more videos for you. So data analysis, support, and resistance. This is going to look slightly familiar to our previous lesson. We're going to look at sample size. We're going to look at the context, quality of the data, and we're going to keep in mind the psychology of the market participants. Sample size. What things does this entail? How many data points or candles support our argument? How many disagree with our argument? Is there a candle that's gone through the level we've marked? For how long has this area held as support or resistance? Context. How far did the price travel afterwards? This will be explained further in an example. Quality. How long ago was the data used? More recent equals better. Remember I told you guys before, recent data is a far more accurate representation of the current market. Finally, psychology. Is my area likely to be a psychological support or resistance? I'm going to explain to you what psychological support or resistance is and why this is important to bear in mind when forming our arguments. Sample size. Let's talk about how many candles support our argument, or data points is a better expression than candles. Here's one data point here where we can see the price somewhat holding this level. It's not a perfect hit, but it is good. Here we have another data point. Another one here, and again, not a perfect hit. And then here we have multiple back-to-back data points supporting our argument. So what do we know from this? We know that without a doubt, 6,000 level is a significant support level. We don't know how strong it is from this, but we do know it is definitely one given the number of data points we have. Next, let's look at how long this area has managed to hold as a support. Well, here's November 2017. And here's November 2018. That is a year. For a whole year, this area has held as a support. That strengthens our argument. Context. How far did the price travel afterwards? In this example, not much happened. It was our first data point, and I won't assign much context analysis to this. However, here we can see a massive move from the bull army. So as soon as price hit this level, buyers stepped in and rallied the price up to this level over here, or just above 11,000, until price came back down. And given the strength of this move, it's unsurprising that the buyers preemptively stepped in this time. So we see the demand has almost increased. However, remember, we're always looking for an equilibrium point. Even though the price bounced up strong, it found its deviation from the equilibrium was too far over there. It came back down, bounced, but look at where it found its deviation next time. It took a lot less for sellers to step in. So sellers stepped in earlier this time. Sellers are losing confidence. Price went down. Now, look, buyers stepped in there. This time buyers are stepping in here. So people often like to analyze how many times a support level is tested when trying to figure out its significance. I like to look at the context under which it's tested. And as we can see, level 1, level 2, level 3, level 4, level 5, every single time it bounced, it got weaker and weaker. What does this indicate? That equilibrium point, it's not being found anywhere up here. So every time buyers step in, the sellers panic and bring the price back down. As we can see from the recent data, to me, this indicates that this level is getting weaker. The buyers are getting exhausted. The buyers are no longer able to push the price up before they give up, or the sellers step in and push it back down. So context is weakening this argument as a support. Every single time we see a bounce go up and go up less than the previous bounce, it shows me that that buyers are getting weaker. And a quick note on psychology. Obviously, every previous argument takes into account the psychology of the participants, but the particular point I wanted to make clear was certain numbers hold psychological significance. So what happens is that people attach some sort of sentimental value to these round numbers or attractive numbers. Depending on the context, it could be 500, it could be 600, it could be 6,000. Here, it's clearly 7,000, 8,000, 6,000, but it's something to bear in mind, and it's something I've definitely noticed and taken into account when performing my analysis. In the last part of this lesson, we're going to study support and resistance flips. So when a support is broken, and broken is something that can vary in definition from person to person. For some people, broken will be a higher time frame candle close. For other people, broken could be a certain moving average going through a level. Broken could just be a wick going through a level. It varies from person to person, and the only way you can make rules is by testing and figuring out what works in the current market you're trying to trade. When a support is broken, it becomes a resistance, and vice versa. When a resistance is broken, it becomes a support. The stronger the support was before it was broken, the stronger the resistance is expected to be afterwards. And all the same principles that we've studied up until now apply to a level once it has been flipped. In terms of market psychology, we have the same participants, longs. Longs were the people who bet on the price going up. In this example, we're looking at a broken resistance. So longs wanted this resistance to break, and it finally did break. So what are they feeling? Regret that they didn't buy more. So now the level where they previously sold at, that the price has gone past, they want to buy it again. Short sellers are at a loss. They bet that the price was going to go down at this level. This is now their break-even level. So when the price comes back, they'll want to buy and close their shorts, or enter longs even. Flats, people who had no position, are now less likely to sell at this level and more likely to buy for the same reasons longs and shorts have flipped their biases. So we're going to go over a pretty good example here. We're looking at the Bitcoin chart versus US dollar. And this area I've highlighted here is a support level right now. Well, it's acting as a support. We can see at this point here, it had a touch and rejection. So slight indication of a resistance, but remember, analyze the data. This is a very small sample size. And in the context, it's not very significant if we look at the size of this move relative to the size of this small rejection over here. Very small sample size, not too relevant in the context. But what happened afterwards? Price came to here, bounced. Price came to our zone, bounced twice, bounced again here, bounced again here, and bounced again here. So now we have several data points confirming this level as a support. If you remember what I said about context, every time we test this support, what do you notice happens afterwards? Price comes down, price goes up, but not quite as high as last time. Price tests the support, goes up, not quite as high as last time. Goes up a little bit higher than the previous time, but again, not as high as either of these two times. So this is slowly getting weaker and weaker. The demand is getting exhausted, and sellers are no longer able to sell at the higher prices they were able to sell at. So they need to reduce their prices. So this is a weakening level. What happened afterwards? Well, price smashed through, and look what happened to this level. Price came back up, tested it, it acted as a resistance. Price came back down, came back up to it, tested it, rejected a little bit, came above, acted as a support for a bit, broke below it, and when the price came up, it's a little bit below, but acted as a resistance over there as well. So we can see how the price flips this level from being a support or a resistance depending on whether it's above or below. Okay, so that is everything for this week's lesson. This is going to be the biggest homework assignment you guys have had from me because there is a lot of practice needed to get good at using these support and resistance levels, good at drawing them, and eventually, hopefully, using them to make yourselves profitable trading systems. So, homework. First assignment, make sure you've taken notes on this lesson. Guys, if you're not taking notes, you're probably not going to remember most of it, so that's all that needs to be said there. I'm going to say it for every single lesson. Next, start to gain experience. Get on TradingView, start drawing support and resistance levels, start seeing how they hold up in the market. Just scroll back, find any place in time on any time frame on any asset and draw levels. Start gaining experience. Next, I'm going to link some videos in the description where you guys will see me performing technical analysis lives. You'll see me drawing these levels. You'll see the reasoning behind why I draw the levels, how I come up with my arguments, how I assess which levels are significant and which levels are not significant. And finally, guys, go learn a bit more about basic economics. The Economics 101, the demand and supply concepts I've taught you, I've given you a brief overview over what they are. They are huge topics that can be very helpful for your trading if you understand the dynamics of the market better. You don't need to get too in depth, but you really should understand the basics. And the best place to do that, Google. I might link some stuff in the description below, but if I don't, guys, I'm sure you can Google demand and supply and then find some great resources to learn from. And that's everything for this lesson. A special thanks to our sponsors, Femex. Remember, guys, if you want more videos from me, use my link for Femex.